I'll be your coordinator today. If you would like to ask a question, please press the raise hand icon found on your screen if you have joined the call via Zoom. If you have joined us on the phone, please press star one on your telephone keypad. I would now like to hand over to David Ferguson. Please go ahead.
Great. Thank you, Elliot. Good morning, good afternoon to everyone who's joining us. Welcome to Kaspi.kz's second quarter and first half 2025 financial results. I'm David Ferguson from Kaspi, joined on this call by Mikhail Lomtadze, CEO and co-founder of Kaspi.kz, Yuri Didenko and Tengiz Mosidze, our deputy CEOs. So as usual, Mikhail will start the presentation, run you through an update on some of the key initiatives in the second quarter and first half of the year. I'll take you through the financial slides and then we'll open the call up to Q&A. So on that note, over to you, Mikhail. Thank you.
Thank you, David. So let's move straight away into the updates. So for the second Q, we had a good strong performance in spite of the still continuing environment of high interest rates. Our payments continue to perform well, and this is very sizable business. As you all know, our TPV plus 21%, revenue 16%, and net income plus 19%. So we're pleased with the performance. Marketplace continues strong growth. GMV plus 15%, revenue plus 25%, and net income plus 13%. GMV, especially on e-commerce side, continues a strong growth, except the smartphones, plus 31%. I will cover this later in the presentation. And then FinTech continues to generate strong volumes, plus 17%, 21% revenue, and net income plus 8% in spite of the high interest rates this year. Consumers continue to be engaged strongly, probably one of the, we believe, being the leading business in terms of transactions per consumer of 75 transactions per month, and revenue plus 20% and net income plus 14%. E-grocery, the business which we started, if I recall correctly, around 3 years ago, continues to be our probably fastest growing e-commerce business, plus 57% year over year in terms of the GMV. We already have over 1 million consumers, 1.1 million in the end of second Q, and generating 3.4 million transactions. In transactions, we're up 63%, and in the GMV, we're up 57%. We continue expanding the grocery across the country and entering the new cities. So we are now in the 5 largest cities of Kazakhstan, which is Almaty, where we started, Astana, and we also opened this year in October and Shymkent, and we're also expanding in Karaganda. So we have 5 cities now, and we are expanding further in Astana and Almaty. We're adding another dark stores or logistics centers from which we're actually delivering to our consumers, and we're planning to open another 2 basically in 2025. We have also introduced earlier this year a deposit on the fixed term deposit at a higher interest rate. So here we're giving you a bit of a overview of its performance. We're very pleased. This deposit has shown an extraordinary growth of 207% in terms of the amounts and 263% in terms of the number of customers, almost 160,000. And it's performing pretty much as we planned. So as you can see, this is a product which is targeting consumers which are saving for something. And apart from and then basically apart from the consumers which are shifting from our current deposit into into savings deposit because they have savings needs, we also around the third of the volumes is actually a new inflow. So very successful product, and we truly believe that even though interest rates are high, today they will come down in the future, and we just continue acquiring consumers, and those are the consumers which eventually are transacting through our services because we are a transactional business and we allow sellers to sell, buyers to buy. So when there are consumers with the money and savings, eventually they're spending those through our services. So really encouraging trends of the deposit products which we've launched. We also have been giving an opportunity to others to leverage our payment network, Kaspi QR, which allows our merchant partners to accept the payments not only from users of Kaspi.kz mobile application, but actually other of our colleagues on the market. So have seen very good results. The volumes are up 128%. We have processed in the second Q 3.4 million transactions. At the moment, we have 5 banks working with us, and as you recall, we also have integrated with Alipay, and through Alipay, basically, we're allowing our consumers to transact on their vacations in China or other locations where Alipay is functioning, as well as our partner merchants to acquire and to pay basically for the goods that they might acquire in China and then bring to Kazakhstan and sell through our marketplace. So very encouraged by those trends, and we'll continue to partner with other financial institutions going forward. But already it's a pretty good, decent result. We also are historically, as you know, we are building up on our payment infrastructure and the payment use cases. This is how we actually started our e-commerce business. This is how we've started our travel business, just taking advantage of building additional value through specific vertical related innovations. And here is an example of our entry into the restaurants business. So we are scaling quite nicely. It's a very high growth, still not sizable in terms of the size because we have just launched it, but quite good, encouraging result. Net Promoter Score is very high from our customers and merchants. The functionality is pretty straightforward. You are, as a restaurant, you basically are reducing the time for your waiters to spend on bringing the receipt and so on. So they're focused more really on the serving. As a result, restaurants get more sales. This is especially in the peak time. So this is the biggest benefit for the restaurants. From the consumers, quite straightforward functionality. You just scan the QR code, which you have on the table, and you pay straight from our mobile application. And one nice feature, which is also part of the service, is you can actually tip the waiter. And the waiter is, waiters are happy because everything goes seamlessly. And so we're delivering the value for everyone involved in the service, in the restaurant itself, in the consumers, and for the waiters. So it's everybody working faster, more efficiently, and we enable our core competency through the technology, which is accepting payments fast and providing a very reliable service. We also have been expanding the suite of our advertising tools for the merchants. This business is growing really fast. And we have launched a new service for our merchants, which basically enables the merchants to provide the cashback sort of bonuses directly to consumers. Very simple service to operate. We have positive feedback from merchants. You can basically select the promotional terms, select the products you would like to promote, and then you just push the button and you can basically track the sales, uplift, the views, and other metrics related to advertising. So have been really well received. As you know, our strategy is always to be rolling out their services with the confidence that we deliver the value. So we're still in the process of scaling, but already have a very good results and engagement from the merchants. So this service continues to fuel our advertising services growth. So as you can see, our ad revenue has increased by 67% in a second Q. And yeah, this is one of the services which we're extremely happy with the trends and engagements, and more to come. We also have been describing and explaining to you during last call that we have growth of the smartphones has been temporarily impacted by the requirement of really the register smartphones, which is, in a simple words, it's quite natural. The legislation has been introduced, which require the consumers to register their smartphones. If this smartphone wouldn't be registered, then it basically becomes an operational brick. So from our perspective, this supply and the consumer demand disruption just happens temporarily, really. But we still would like to indicate that actually the growth of all other verticals in our e-commerce continues to be very strong. And without the smartphones, the growth is at 31%, which just an indication how underpenetrated e-commerce is and how much growth we have ahead of us. And things like beauty and personal care and clothing are growing 63 and 54% respectively, just telling you, that there is still more growth and the innovations we can do around specific verticals, but the smartphones, this temporary setback. But we also are not just sitting and observing. We of course are introducing the services for both merchants and the consumers just to give them peace of mind and understand that actually the phone is registered, and we have developed a service for both merchants and consumers to overcome this obstacle. So actually merchants, before shipping the smartphone through our e-commerce, they must check the smartphone whether it's registered for bringing inside of the country on the one hand, and then on the other hand, merchants earn the badge which on their product, which means verified by the merchant, the smartphone. And on the other hand, customers themselves also can verify smartphones and make sure that the smartphone they have acquired is the smartphone which is registered. So as a result, we are sort of tackling this from the both sides. We're giving tool to the merchants, we're giving tool to the customers, and yeah, we just believe that the demand is there, and we just believe this is temporary setback due to the regulation, which just requires a bit more, communication and help from our side, and that's what we're doing. We have also are very excited to introduce the new service, which is domestic tours in Kazakhstan. Kazakhstan is a beautiful country, and there are so many destinations that you can visit, and it can be over the weekend, it can be a quick trip into mountains, it can be a ski resort, or you want to spend a week in the beautiful nature with your family. So we have introduced the domestic tours, and basically, as you recall, the travel, we have international vacation packages. So that's is specifically targeted to promote beauty of the country, and we have developed the functionality which has been well received. You can choose the region and the dates. You can browse browse a list of offers, you can read the tour details and understand those better, and then you can seamlessly pay in our mobile application and you get confirmation for your vacation. So really nice tour. Obviously we've started from the low base, but it's 10x growth in June. It's the season now, so we observe quite the strong adoption. But again, this is the service which we will be purposely also promoting and building up. We are really honored and excited to promote the beauty of the country, and Kazakhstan is truly beautiful. Has so many beautiful locations to visit. So we're very happy and excited about this new business we have launched. David, back to you about the platform performances.
All right, thank you, Mikhail. So just to run quickly through the financial performance of the respective parts of the business, starting with payments. Demand volumes remained robust and consistent throughout the first half of the year. Volumes up 14% year-on-year in the second quarter, up 15% year-on-year for the first half. Faster TPV growth versus volumes is a function of higher ticket size, inflation, up 21% year-on-year in the second quarter, up 22% year-on-year for the first half. So again, strong and consistent trends with, as usual, sort of three key products, Kaspi.Pay, B2B, and bill payments all contributing. Take rate moved down, a function of mix effect, again, consistent with what you've seen now over the last couple of years. Basically, as QR grows in the mix, its take rate dilutive, but this is consistent with the long run trend. Payment revenue up 16% in the second quarter. So even with take rate dilution ahead of volume growth was 14% in the second quarter. So that also reflects both strong volume growth, but also good growth in liquidity revenue. And then again, as you've consistently seen with the payment business, strong top line drops through to the bottom line. So faster bottom line, high profitability and faster profitability growth, up 19% in the second quarter of the year and up 20% for the first half of the year. Moving on to marketplace. Again, marketplace demand overall remains very strong and consistent, up 35% year-on-year in the second quarter, up 36% year-on-year for the first half. GMV growth is lower than volume growth, although we did hold Juma in the second quarter and it was successful overall in the second quarter. Number one, we ran fewer promotional campaigns, and number two, as Mikhail talked about, declining smartphone sales down 17% year-on-year in the second quarter. That impacts GMV. It doesn't really impact volumes to the same extent, but smartphones are a higher ticket item, so it's more apparent at the GMV level. Despite that, strong take rate improvement being driven as usual by advertising revenue, delivery revenue, and revenue from classifieds. Take rate moving up 70 basis points year-on-year in both the second quarter and in the first half of the year. That will feed through to faster revenue growth. If you break it down by the respective marketplace segments, decent e-commerce GMV growth, up 22% year-on-year in the second quarter, up 23% year-on-year in the first half. If you exclude the smartphone category, e-commerce growth in the second quarter would have been up 31% year-on-year. Take rate moving up 120 bips in the second quarter and 130 basis points improvement year-on-year for the first half. So pretty decent take rate expansion. M-commerce, slower growth, also just like e-commerce impacted by smartphones, but also M-commerce is being impacted by the structural trend of offline merchants moving to online. The beauty of our business model is we capture both, and M-commerce, actually that relationship with the offline merchants is a source of competitive advantage relative to online only merchants. So solid growth and solid take rate trends, around 9% in both the second quarter and first half of the year. Travel continues to deliver good results. GMV growth up 16% in the second quarter, up 19% year on year in the first half of the year. Helped still by international tours that we launched approximately 18 months to 2 years ago, and international tours also drive that take rate expansion here also. So 50 bips of take rate expansion year on year in the second quarter and 60 bips in the first half of the year. We'd expect international tours to remain growth and take rate additive in the second half of the year. And we'd expect domestic tours, Mikhail just talked about them, to increasingly kick in as well over the next 12 months. So a decent outlook for travel. With take rate moving up, revenue growth is ahead of GMV growth. So revenue growth for marketplace was up 25% year on year in the second quarter versus the GMV growth I showed you of up 15%, and for the first half up 29% versus GMV growth of 17%. So overall, pretty healthy revenue growth expansion for marketplace, and also decent bottom line growth, up 13% and 16% year on year in the second quarter and first half respectively, albeit that ongoing trend of as e-grocery grows in the mix, that is a lower margin business, but overall a good result for marketplace. And then finally in Kazakhstan, fintech origination remains pretty healthy, up 17% year on year in both the second quarter and the first half of the year. As you've consistently seen over the last couple of years, that origination growth is being driven first and foremost by our merchant and micro business finance products. They grow at a faster rate, continue to grow at a faster rate than our consumer lending products. The average loan portfolio saw strong growth, up 33% year on year in both periods. This is a lead indicator for future revenue growth, and stable pricing trends, flat year on year in both the second quarter and the first half. The deposit base is also now starting to see decent growth, up 18% year on year in the second quarter, 19% year on year in the first half. And what you see here is that we raised rates in April. We started to promote the new deposit products more widely, and month on month trends in the deposit base have started to improve, with June seeing the strongest month on month growth year to date, June deposits being at their highest level year to date. So the trend is now moving in the direction that we wanted to see. So it's good for the future that is coming through that healthy deposit growth. Risk trends remain stable, flat year on year. Cost of risk 0.6% in the second quarter of the year, and NPL trends have moved up slightly, but not materially, and would expect them to remain at around these levels or somewhere between where they were at the end of last year and current levels for the remainder of the year. The lower coverage reflects the growth in the car loan product, which is a collateralized product and therefore requires lower coverage. And again, that has been a trend over the last 12 months as the car loan product has scaled. So a decent fintech origination and stable pricing trends that has translated into healthy revenue growth, up 21% year on year in the second quarter, up 19% year on year in the first half of the year. Higher interest rates have impacted bottom line growth, as we indicated they would at the time of our first quarter results. You see that up 8% in the second quarter and for the first half of the year. But the deposits are delivering what they're expected to do. They will help us capture more transactions or fund more transactions in the future. And if rates move down, fintech will be a dramatic beneficiary. Profitability will be a dramatic beneficiary of that. That wraps up the Kazakhstan side of the business. Moving to Hepsiburada in Turkey. Just to remind people, Hepsiburada published its financial results on Thursday of last week, so its detailed financials are available on the Hepsiburada Investor Relations website. But what is clear in the second quarter, a much better performance versus the first quarter of the year. Here you see that volumes moved back into positive territory, up 7% year on year in the second quarter versus down 2% year on year for the first half. The combination of growing volumes and mid-single digit ticket expansion translated into decent GMV growth, up 16% in the second quarter versus down 1% for the first half of the year. This GMV growth is in real terms, is inflation adjusted, and overall is a reflection of recovery in the retail environment post-March, number one, company-specific initiatives, number two, particularly in the 1P side of their business, which grew faster than 3P during the quarter, and also favourable base effect. Second quarter of last year, or first quarter and second quarter of last year, were impacted by the timing of the election. The first quarter of last year was strong, tough base. With good and improving revenue growth, up 23%, helped by growth in 1P and helped by delivery initiatives, helped by the growth of the delivery platform. That translated into faster bottom line or faster EBITDA growth, up 42% in the second quarter, which is illustrative of the actual strong sort of operational gearing that exists in this business and can be seen as the revenue growth comes through and improves. Net income was negative. Underlying sort of losses was small and declined materially year on year, 243 million lira in the second quarter, an improvement versus a loss of 434 million in the second quarter of last year. But also that's only around $6 million, but there are also some one-offs related both to credit provisioning. This is related to Hepsi's existing credit products, so this should not be confused with our planned acquisition of a banking license in Turkey and the products that we will launch in the future. That acquisition is still on track to complete in the second half, so it reflects existing product set and also one-offs primarily related to Hepsiburada International. But overall, good underlying trends in all aspects of Hepsi's business in the second quarter of the year. So for Kaspi.kz, the second quarter, exactly as we expected it to be, trends in line with our full year guidance, and also actually with Hepsiburada moving as we expected it to be, and its losses ultimately small in the context of Kaspi.kz, number one, and small in the context of the opportunity that exists in Turkey. Finally, guidance in Kazakhstan reiterated, the third quarter has started well, and we are on track exactly where we expect to be. And just to clarify on capital returns, as you know, we have always had and we continue to have an extremely cash generative business in our core market. We told you that this year was about making investments in international, Turkey, to ensure strong future growth for many years to come. We've made good progress completing the acquisition of Hepsiburada. The final payment was made in June. We're on track to close the banking license acquisition in the second half of this year. So as we move into 2026, we expect to be able to once again have capital returns to our shareholders in much the same way was the case between 2020 and prior to the Hepsi acquisition. Capital returns can include both dividends and buybacks, with a decision being made at the appropriate time. So that's it on Kazakhstan and Turkey. I think with that, we can open the call up to Q&A.
Thank you. For our Q&A, if you would like to ask a question, please press the raise hand icon found on your screen if you've joined the call via Zoom. If you've joined us on a phone, please press star one on your telephone keypad. When preparing to ask a question, please ensure your line is unmuted locally. And we'll pause for a moment to allow questions to register. Our first question comes from Wayne Trin with Citigroup. Your line is open. Please go ahead.
Hey guys, this is Wayne on for Ygal Arounian. I just wanted to ask about what you're working on in terms of product improvements at Hepsi. Could you highlight to us which ones are the most important and what we should expect as we progress through 2025 and 2026?
Mikhail, do you want to provide a bit of color on some of the projects that are ongoing at Hepsi, please?
Sure. Well, I mean, in general, I would say that our strategy is to introduce quite a lot of products which we have in our core market. Initial focus or the priority is still to make sure that existing customers and merchants are extremely happy with the current services. Just to remind everyone, our business model is, and our execution skills are really based on ability to innovate at unprecedented rates. If you look at the history of Kaspi and the things we have innovated around in a marketplace or fintech or the payments area. But in order for that strategy to be successful, it's super important that your current customers and merchants are extremely happy. And I'm not saying just like happy, like for any ordinary business, but really happy. And that is a foundation of the future success. And therefore, at the moment, the main focus is really to make sure that the existing services provided specifically through e-commerce business and the payments and fintech to a certain extent, even though it's really small, those are brought to the level of Kaspi.kz's standards. And there are multiple projects which teams are running, and there is everything starting from the delivery to user experience and the fintech products. So this year, as I've mentioned on the previous call, is really the quality and just bring those services to the level which is required by the desire to innovate and all next services being a very high adoption. So the current performance is very encouraging. It results from some of the projects which have been already implemented or are in the process of being implemented and giving a very successful results. And you can see that in the growth acceleration in the second Q. But we're really are focused on the quality rather than the quantity still this year. So main priority again is core business, which is e-commerce and all the services around the e-commerce. And then and the rest, fintech side of things is the major innovations will be coming when we complete acquiring the banking license.
Got it. Thank you. And then maybe a second one for me is how do you think about your growth initiatives in Kazakhstan, the opportunities that remain there, and how should we think about the progression of the restaurant business and maybe any other verticals we should consider?
Well, the growth in Kazakhstan is the market is still underpenetrated, and you can see example of the specific verticals we really showed, like clothing and fashion growing at the very high rates. I think it's, what is it, around 60% or something we've showed. So that there is a growth, and what we are executing really the strategy, which is going after specific verticals. Again, this is something which we'll already have done before and also articulated. E-grocery is a strategy around specific vertical. Buying e-grocery is different from buying electronics, and travel. It's a strategy around specific verticals. The same now we're doing pretty much in all major verticals, and restaurants is one of those. It's a major vertical in the household spending. We've just launched a very simple sort of functionality which brings immediate value. In our estimate, in general, every sort of vertical we're entering, it has to be in the range of $1 billion size sort of market potential. Like that. The same was with travel, the same was with grocery. So it really applies pretty much to all major verticals. If we take a vertical specific strategy, that scale matters, frequency of transactions matters, and this is how we're picking those verticals to deliver the value. And again, we're working on the both sides always. Our business is to connect merchants and the buyers, sellers and the buyers, restaurants and their customers and our consumers from the mobile applications. And our technology enables just to connect them, deliver the value, and then on top of it, we can start bringing up some additional value-added services. In e-commerce, value-added services are around advertising, for example, and the same opportunities exist in restaurants. So we've just really started. We're rolling out at scale this infrastructure of, scan and pay and leave the tip, and then of course in the future some other added value services will come together with the restaurants. I mean, I wouldn't be really saying to you anything new, but the things which are related around in other businesses in the world exist around restaurants, right? Those are the reviews, those are the marketing campaigns, the loyalty programs, the cashbacks, and so on and so forth. So there is a really range of the services which we believe we can develop, but our priority is always we start simple, we deliver immediate value, we get sort of the scale, and then we start innovating by value-added services when both merchants and consumers are extremely happy with our base value proposition. And it's exactly the same strategy with the restaurants. It was exactly the same strategy with the marketplace, exactly the same strategy with the grocery, exactly the same strategy in Hepsiburada. We are really taking our time to make sure that our current offering delivers value, delivers the excitement to consumers and merchants, and then we build with our strategy then becomes, let's build on this and let's start this wave of innovations. And that's what we have done historically successfully. And this is the playbook which we employ always and every single time.
All right, great. Thank you, Mikhail and David.
Thank you.
Great. Thanks, Wayne.
We now turn to Gabor Kameni. Please state your company name and proceed with your question.
Hi there, this is Gabor from Autonomous. I have a few questions on, firstly, on fintech. So I believe your funding costs increased, as you expected, relatively significantly in Q2, maybe around 13-14%, the blended average. Can you help us think about the outlook here? So how do you expect your funding costs to develop if rates stay where they are? My other question would be on asset quality. I noticed the uptick in the NPL ratio and that your quarterly provisions seem to imply a 2.5% provisioning rate. I believe you formally guided for 2%. Just some color on how you think about asset quality going forward. And finally, on your comment on a balanced capital deployment from next year between cash and distribution and investments. Can you help us scale the investments in Turkey beyond the banking business, the 300 million you indicated? And in relation to that, I mean, given the stock's valuation, at what valuation levels would you say that you rather allocate a substantial part or most of your free cash generation to share buybacks? Thank you.
All right, Gabor, I can make a few comments on that. So cost of deposit funding increased 70 bips year on year in the second quarter. And the second quarter pretty much reflects the full impact, i.e. we raised rates not on the 1st of April, but very early in the quarter, and the new products are out there. So between that and around a sort of 100 bips level is probably a reasonable expectation in terms of how the cost of funding increases over the course of the year. So that's on your first question. And that's actually consistent. We said that at the first quarter results. On the second question on cost of risk, what you should remember is in the first quarter, we did put through additional macro provisioning related to higher interest rates. So that's sort of separate from underlying risk. Underlying risk trends, so what we actually see are stable year on year. So let's see if that macro provisioning is needed. So that's on that. On the third question from my side, I would just say, I mean, the bank acquisition is happening. So that needs to complete in the second, and that's a call on capital. That decision is being made, and it's fundamentally important. And I mean, it's actually a major competitive advantage to secure a banking license within such a short period of time. I think going into 2026, again, the point is that we're very, very fortunate that we have this massively cash generative business in our home market, and nothing has changed in that regard. Now, I said a decision around sort of mix between, if there is a mix between dividends and buybacks, we make that at the appropriate time, and that's true. But I think it would be fair to say today, if we were making that decision today, there's an incredibly strong case for share buybacks, and I doubt we would see any pushback from anyone on this call around that. But we'll make that call at the end of next year, end of this year, beginning of next year.
Okay, thank you.
We now turn to Darren Peller with Wolfe Research. Your line is open. Please go ahead.
Guys, thanks. Just real quickly, I mean, the smartphone impact, I know you called out the actual quantitative impact in the quarter, but number one, I mean, do you feel like the progress you're making on certain partners is going to help stabilize that? And should we just expect that to be something that anniversaries in a couple of more quarters, or is it a gradual impact that progresses in any way? And then when thinking about the marketplace segment, I know you talked about less promotions around Juma. Just curious what the dynamic where the thought process was there. And putting it all together, I mean, sustainable growth, you have some puts and takes this quarter. So sustainable growth, I mean, you have a lot of drivers that are being innovated right now that you talked about before, but help us understand your updated and latest thoughts on the recent growth trends, how you think about that segment over the next year or two, just given what's really in front of you going forward. Thank you.
Do you want to take that, Mikhail, on the smartphones and promotional activity?
Yeah, sure. I mean, Darren, in general, thank you for your question. In general, I would say we are trying to sort of explain, just showing the growth in other verticals, right? So, as we've explained, the growth in e-commerce without smartphones is 31%. So, it's really healthy sort of growth rates. And for example, clothing and the beauty are growing around 60% year over year. So I think it's a good indication of the potential really of the marketplace business. And the smartphones, the projections for what's going to the smartphones, I mean, we haven't been really in a similar situations before. So the only thing what we are doing is what can bring the results and what we can ourselves control, right? And what we are developing is a service which gives comfort and peace of mind to both merchants and the consumer. So demand for the smartphones, for example, is there. It will have to be satisfied at some point. I think we are doing the services which will enable to sort of cross this obstacle or doubt that consumers and merchants currently have around these devices. And we just believe on our side that this demand will have to be satisfied eventually. So that's basically where we are in terms of the smartphones, and we are doing our part of the job. Yeah, we're not over promising anything. What we're saying is we look at the consumers. This is our job, is to understand the merchants and consumers, because this is where our expertise is, and they do see the obstacle in their purchase decision, and we have developed the service which will enables them to overcome this hesitation to acquire smartphones, and hopefully the market, the trends will recover, because again, there is a demand. So nothing happened really with the demand. This is sort of the obstacle which was created with the introduction of requirement to register the smartphones. But again, if you take the smartphones separately, you can see that the growth, even in electronics, excluding the smartphones, growth on our platform is 26%. Home and garden and furniture, 35%. Clothing, 54%. So those verticals are growing really at the very healthy rates. And therefore, yeah, on our hand, we just believe that demand is there, it will recover, and we just need to do our job. And our job is to enable transaction between sellers and our partner merchants and the customers, consumers, and enable this transaction through the technology which we know how to develop, and the tools of data which we know how to use to help both parties. So that's what we're doing.
And then just on, I was touching on Joom also, your decision there, and then just the sustainable growth rates there. And just real quickly, profitability on fintech also, and how we should think about that platform now with rates where they are, where they're likely, and just given your success on deposit rates and deposits in general. I'll leave it there. Thanks, guys.
Well, I think the basic sort of observation there is quite simple. If we're in a high interest rate environment, we have to take this as an opportunity to acquire more customers with the savings and build up these capacities, because customers with the savings are the most valuable customers really for any of our products. And yeah, we are in a high interest environment. I am not macro person, so this is not my specialty to explain. But our job is, when we see this environment, we take most of it, and interest rates eventually will go down. And the way we sort of look at this in our business, that there are high interest rates which evaluate our interest expenses, but this is almost like the cushion, on the expenses side, and eventually it will go down. And as we're focused on a very healthy user base, as we're focused on a healthy risk metrics on the fintech side, eventually profitability will follow because the top line is there and the risk is a world class, and interest rate eventually will go down, and therefore this will flow to our bottom line.
We now turn to Reggie Smith with JP Morgan. Your line is open. Please go ahead.
Hey, thanks for taking the question. I guess I just wanted to clarify the comments around the dividend and share repurchase potential. It sounds like you guys obviously have some capital commitments on the bank licensing side this year, but as we think about 26, should we assume a similar, I guess, return of capital ratio? I think it was like 60% in 24. Should we assume that going forward? I know you suggested that I guess you would resume a similar type cadence, but I'm just curious about the ratio, recognizing that there may be some investment in Turkey. So should we think about it being in the same range as 24, split across dividends and share repurchases, or something less than that?
So maybe
thank you, Rich, for your question. I think that basically what from our perspective, we mentioned always that we'll be prioritizing the investment for the further growth, and that's very exciting opportunity because we're building business for many years in front of us, and we have this internal ambition, as we mentioned, that we would like to be a company of 100 million users, and that's what is on our minds, and that's very important. So always we have to keep that in mind. At the same time, what we're also saying is this year has been an extensive year for investments. I mean, the size of investments that we have done are quite substantial. And when we go into the next year, there will be a balance between, our ability to distribute capital to our shareholders, either through the dividends and the buybacks or and investments. Again, investments will be important, but we're lucky to have a very, profitable and cash generative core business, and that's what allows us to think in those terms for the next year. I mean, whether specific payout ratio or anything like this, at this stage, it's quite early to have those specific discussions. So we will make those decisions, as we go forward.
And I just sort of
Yeah, that makes sense. And then thinking about
just to add to that, if I can, Reggie, just one point. There will be investments, and there always has been investments. You should keep that in mind. So e-grocery has been a massive investment. The largest poster network in the country, in Kazakhstan, has been a massive investment. So again, the business has the potential to achieve a balance, make investments, and return capital.
Yeah, I understood. And then just thinking about the banking license, does this put you on par with competitors there, or does it kind of extend or create a gap where you'll have capabilities that some of your competitors in Turkey won't have? And then finally, as I think about the investments, obviously capital for the banking piece would be one, but like what do investments look like? Is it rewards to consumers? Is it like, maybe talk a little bit about the nature of what investment looks like in Turkey. Thank you.
Well, I mean, in general, I would say that the license, obtaining the license is a very important step for a very simple reason. But the license really gives you an operation that can offer products to consumers and the merchants, both on the saving side or on the lending side. And that's basically what a license really allows you to do. At the same time, I would say that, if you think about the Kaspi and the way we really operate, we're focused on the quality of the services we provide, and we're focused to the lesser extent on, competition. And from our perspective, I think the products and the services and the expertise we have on the fintech side is a world class, and the products that we have, which can be introduced in the Turkey, is also world class. So from that perspective, once we get the license, I wouldn't expect like quick wins. You never saw from us that we always like to discuss the results and actual trends when we do something, rather than just tell you about some ideas which we have been working for 3 or 6 months in a pipeline. So we always do something, and then we tell you the initial encouraging results and how this is going to evolve. So step number one, get the banking license. Step number two, just put the framework to launch the innovative financial services for consumers and merchants. And then we just believe that we can make a difference in the consumers and merchants' lives, just because the services we have are technology and machine learning, AI driven, and they're really really improving everyday life of our customers and merchants and their needs. But that's basically so that the big and taking and building up the bank, of course, it also requires our diligence with the compliance, risk management, and all other requirements, which we have a lot of experience in. But that obviously also requires from us to be very detail oriented and execution driven. But once we get the license, again, we'll be introducing and launching the services which you already guys know on the Kaspi side for a long time.
We now turn to Cihan Saraglu with HSBC. Your line is open. Please go ahead.
Hello. Thank you very much for this call and the presentation. I have two quick questions. One is, in the past, you used to distribute dividends or announce the buybacks on a quarterly basis. So, based on your comments about resumption of dividends in 2026, shall we expect dividends to start in the first quarter of 26, or is that just a broad guidance? That's one. Second question is about fintech bottom line, which on a Q-on-Q basis seems to have grown despite the increase in funding costs. So you could explain what mitigated the increase in funding costs beyond volume growth there. Thank you.
Okay, so thank you for your question. On the dividends or buybacks, basically returning the capital, I think, as we said, there is not much really to add. We can't really commit to you at this stage on quarterly or semi-annually or whatever. So we're just saying that we have a very good, solid cash generative business, and there is the next year we'll be finding the balance between the investments and distributing capital to our shareholders. I mean, everybody should also keep in mind that I'm shareholder in the company, and I'm making decisions based on what is going to bring the most value to the company and its shareholders long term. So I am investing alongside with other shareholders. In terms of the question about the fintech business, I think we did mention this before. Exactly what happened. The volumes increase. With the volume increase, revenue increase. With the revenue increase, profits increase. So the revenues just picked up in the second half, in the second quarter of this year, and I think we did have a discussion in the first Q about it. And volumes are nice, and therefore the profitability is following on the fintech side. But profitability would be growing much faster if interest environment would be interest rates will be smaller. So therefore, we're focused on the top line, and the bottom line will follow in the future. Has been our strategy always.
Thank you.
That's all the time we have for Q&A today, and I'll hand back to David Ferguson for any final remarks.
Okay, so thanks, Elliot. We've got to wrap things up now. We have another meeting starting shortly. So thanks a lot for everyone's time today. Please feel free to get in touch if you have any questions. But thank you. Have a great summer, and we'll speak to you at our Q3 results. Thanks, everyone.
Thank you, everyone. Have a good week.
Thank you, everyone. This concludes today's webinar. You may now disconnect from the call.